All right, so the rally continues. I'm going to break down this little bullish move that we've been having and see how trend changing it is. What do the indicators look like? You know, how do we look any different than we did Monday? Monday we've been kind of rallying here for the past little bit. So are we getting the kind of pattern we need to see to feel really good? And are we seeing it maybe on one of the indexes and not on all of them? So we're going to take a look at each one of these from most bullish to least bullish to kind of get an idea and gauge and see what that means. You know, which ones are most bullish and why that's important and what impact that can have on, or how that can reflect risk appetite or not. We're also going to take a look at a stock that itself is kind of showing us the pattern we want the markets to show us. And we're going to talk about how to trade that and why it looks as bullish as it does, and then we'll trade it. So let's go ahead and get started. Today is Wednesday, February the 9th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see your intermediate market sentiment lines pretty much going sideways inside a neutral territory. So, but it is a good little short-term sentiment bounce. We did get up to last Wednesday. Is that last Wednesday? Or last week's high point there. Also happens to be, this time, the 30-day moving average. We got a, 0.07, 700% above the 30-day moving average. Simple moving average. We are also at the 62% retracement resistance of this declining move, of this bearish impulse move. So it's a pretty strong pullback. We did not get up above the 90th percentile this time. We did here, but we so far have not this go around. So there's an opportunity for us. There's an opportunity for resistance to hold here. Very important opportunity. Kind of interesting to see the different reactions to the different averages. If you look at the NASDAQ, so there's the S&P, that's the most bullish. If you look at the NASDAQ, it is not above its moving average. It's still actually well below the moving average. And it's barely above the 38% retracement. It's nowhere near the 62% retracement. So you can, but it is near last week's high, not quite up to it like it was last time, but you can see a much weaker chart. And of course, your Russell 2000 isn't even to, also not to the moving average, is above last week's high point. So it's more bullish from that perspective, but still, it's actually below the 38% retracement of this longer decline that it's been on. And if you look at, you know, the same decline that all these other indexes have been on here, you can see, let's see here, yeah, about that high. Looks like that's the highest high. You can see it's also not above, like it's not anywhere near the 62% retracement of that level, which is right where my cursor is, right here. So again, it's weaker than what we're seeing on the S&P 500, and even more than that, if you look at the Dow Jones Industrial Average, that is even more bullish than the S&P. It is above its 30-day moving average by 2/3%. It's above that 62% retracement. It is above last week's high point, and you've got dark green shading, like your market sentiment and intermediate line are actually rising. They're still both in neutral territory, but they're rising. Your near-term line did get above the 90th percentile. So that's great. Small average, small range, but still great to see that that's the move. But the problem is when you look at the relative strength of the like say the NASDAQ 100 relative to the diamonds, which you can see is really bearish right now. We're below the 50-week moving average. Anytime that we're bearish on this, that's not necessarily you know, when we actually come to a decline. Fourth quarter 2018. A little bit in 2000 begin after that March of 2021 period. 15 and 16, you can see some weakness there in this. There's your 2011 to beginning of 2013. So it's not typically the most bullish of markets when the diamonds are outperforming the Qs this much. I mean, you're considering the diamonds your blue chip, and your Qs right now your market leaders, your tech mega cap names. The names that you expect would lead us higher. So here, let me go to a daily chart on this. All right, so you can see here that we are this is the diamonds relative, the Qs relative to the diamonds. A good up the last couple of days, but you can see we are below the 200-day moving average. The price, in this case, the relative strength line's gotten below. The 8 and 17 got below. The 30 days down below. We're still below the 17. We're in convergence mode You can see the PPO, the long-term PPO is falling, and we are in this strong ADX and strong bearish levels, and we're bouncing back up to the 17-day. Of course, breaking through some of these levels would be a renewal of this strength, but since that post-Thanksgiving peak, the diamonds have really just been killing the NASDAQ composite. In fact, when you look at let's go back here to our asset class comparison chart. Here, let's go to this one, asset class comparison. We'll go out from that November 2021, that Friday. That's when things really kind of started to hit the fan from an equity standpoint. You can see that everything dropped that day. The IWM is still down nearly 11% from that day. The Qs are still down 8% from that day. But your S&P, which again is more correlated to the Dow than these, is up 2.5%. Or is only down 2.5%. So you can see the relative strength. You can also see gold doing well, commodities doing well, the dollar relatively weak. Bond yields are higher. Global bonds are down. International equities are outperforming U.S. equities. So that's kind of the scenario you get when the diamonds start to outperform. When the diamonds here start to outperform gold. In fact, the diamonds kind of peaked. Let's take a look at it here. Looks like the highest close the diamonds got would be that day right there, and that is November 30th. So that's the highest close. It was actually the next, would that be the next Monday? Is the highest close here. And so again, there's how stocks have performed. 7-8% losses on the IQs and IWM. S&P is only down 1.5%. Emerging international stocks are actually positive from that day, and commodities are just killing it. Right? This is the environment where the diamonds outpace Qs. So that's what we're seeing here on the market forecast chart. You're getting a much more bullish chart on the Dow Jones than anything else. With today's kind of gap up and breakout, small range nonetheless, and not much of a gap. If you look at the close, they're at 35,400 to the low point, so you're getting about 150 more points. So you add 150 more points, you're looking about, which is actually less than the range. That means that most of today's range has actually occurred overnight, but you have 200. That'd be 350 points. And you have 560 the average range. So, again, not really the biggest breakout move, right? If you're going to be breaking above these resistance, remember, we don't get a bullish impulse move until you get above the 78% retracement. Let's take a look at the long-term charts. We have a green arrow. The week's not over, but we have a green arrow. That's a good sign. We still have falling PPO, so we're not quite there yet. Remember, the Dow Jones looks more bullish. The Dow Jones, you do have the green arrow there too. The PPO is slowly starting to turn around with a positive differential. So you have, a positive going in that direction. You do have some pretty strong histograms going on the MACD right now. In fact, if you look at that histogram, for example, on the S&P, if you kind of follow my cursor along to the left, you can see this histogram right now at these levels is about as high as we got over here. And then, of course, we started to grind higher there post-October expiration. And we think, that was kind of very similar to this. We broke out from below these moving averages, took off on low volume and very small ranges, right? And the MACD histogram was dropping, and eventually the MACD peaked. Now, keep in mind, at that level, the MACD itself was pretty positive right there. This time, the MACD still isn't positive at all. And we're still below moving averages here. Whereas over here you were easily above the moving average. So very different MACD histogram peak. We're getting pretty strong levels, even on IWM, a pretty strong histogram level here, again, relative to where we've seen in this past year, but we're still actually below moving averages, well below moving averages in this case of IWM. There's SPY again. You can see we are still below the 30, 50-day moving averages, but above the 200, so just kind of trading in that gap. The 8-day is about to cross the 17, depending upon whether we fill in that gap. And again, you look at the range here, we closed at 450.94, the low was at 455, so you're looking at about 4 points of range overnight from 4 basically 451 up to basically 455. So 4 points of range overnight on SPY, and today's range, the regular trading session, was 288. So again, by far more range overnight than what you had in the regular trading session. Combined, is still less than, and pretty easily less than what the average has been. And again, like I said, lower volume, again, third consecutive day of below average volume. So smaller ranges, small volumes, and gap going into resistance levels. Whether it's resistance at the moving average, resistance at the Fibonacci retracement lines. QQQ, again, strong histogram already. Still below moving averages though. And you're trading up above the 17-day, but still kind of, again, filling in the gap between the 17, in this case, the 200 today. The 30 still above us. We're still below Fibonacci resistance. We're still easily below the 50. 30's crossed below the 50 a while ago on QQQ, and it's just barely crossing on SPY, and it's not crossing on DIA. It's actually still above it on DIA. And in fact, the diamond's breakout today got you above all these moving averages. Again, it kind of shows just how bullish diamonds. In fact, the diamonds are pretty close to breaking out of the value area of its 1 year compared to IWM, which is well below the value area of the 1 year. So it shows the relative strength right now for the diamonds. But again, this is not really the chart. Remember, the Qs, are well inside of the value area and just barely above the point of control, and below the 200-day moving average. You don't necessarily want the diamonds to be the one with the relative strength if you're going to maintain a good, strong, bullish trend going forward from here. All right, so that's what these moving averages are looking like. If you look at the charts here on the DMI, for an example, you can see that we are almost not bearish anymore on SPY in terms of like the negative indicator getting back below 25. The positive is a smidgen above 20. That can lead to reversals here in a minute, from when you're just barely like that. It's like this. IWM is barely below 25. The positive is barely above 20. So we can keep on going, but sometimes this can lead to just a reversal back to the upside. So something similar to this, this kind of a chart. In this case, the positive wasn't above there, but that would be the idea, right? Especially when you have an ADX that's still pretty darn high. And then finally, your Qs, which you're not above 20, and you're still not below. You're not anywhere close to being below 25. So it kind of goes to show where you're at. Even your diamonds aren't below 25, considering how relatively bullish it's been. When you look at the RSI and the CCI, we're in the upper half. We're in bullish. We're in the bullish half of these oscillators, though we're not necessarily in strong bullish. We're not in trending territory here. If you look at the diamonds of the Dow Jones Industrial Average, excuse me. Again, we're not in bullish territory. We're not in trending bullish territory. We're not in bearish territory at the very least. And then if your Russell 2000 is just barely above. CCI is looking strong. I mean, that's a strong run. We'll see whether that's actually a trend changing run on the Russell to break you through. If you look at the Bollinger Bandwidth, we are in the middle band. So we're not, when you're in the middle half of the bandwidth, you're not really trending. If you're in the upper half, the outer half of the bandwidth is when you're trending, either to the upside or to the downside, right? When you're in the lower half, the hour half, either the upper quartile or the lower quartile. When you're in the middle half, like we've been for last week, we're really not trending. We're just kind of getting back to the middle half as the bandwidth comes down from a very high level. I mean, again, we haven't been this high outside of COVID, right? If you follow my cursor along, we were this high back here in October, and then you can see there's fourth quarter 2018. We got even higher than where we're at right now, and this is about as high as we got in the first quarter of 2018. So it's a really, really high bandwidth, and we had been trending in the in the lower half, and you can see you can trend for a while. That's COVID, and here's fourth quarter 2018. It had, after trend, and while trending in this lower outer half, there were a few times where you got back into the middle half, and right now, as of right now, it looks very similar now to what we saw back over here, or even back over in this time frame in the first quarter of 2018. Let's take a look at the, the intraday chart. So give me 1 second to pull that to see what that gap looks like. I tweeted this out here earlier today. Look at that range relative to what we've seen. Right, we filled in the rest of that gap, though we did most of it overnight. See, we were holding it initially for a resistance, but we filled in the rest of that gap there. Now we're holding the top of the gap for resistance. Again, with a very small range. So most of today's move occurred overnight on very light volume, and then the rest of today's move occurred in a very tight range on a little bit below average volume. I mean, still, but not above average volume. Remember, we are still below moving averages, and we're getting small moves and small ranges, right, and small volumes. That's the SPY. I remember the diamond's a little bit more bullish, so it's actually above last week's high, but just barely. There's the Qs, which is not above last week's high, and a little bit bigger range, above higher high and a higher low, against filling in that gap still. And there's IWM, also above last week's high point, but a very small range, right? And a gap that you would expect to fill in. You would expect this is a common gap because we didn't break through a significant resistance with a significant amount of volume. So you expect it to be a common gap, which means we fill those in relatively quickly on all of these indicators. You look at today's volume and range. I already talked to you about the range there. You have to add a few points, right? So from 451 to 455, from the close to the low, that's another 4 points. So you're just under 7, and then you had 91 million shares trading hands. So when you look at that in context, you're just under 7 points. So down over here, below the average, 100 some odd million, also below the average, 91 I think it was, below the average. And then you can see the ATR relative to the price up here, still at pretty high levels. So we're still, we're not necessarily not trending anymore. SPY, it did break that strong bearish trend. We're still below the cloud. The red line's still below the price, and still will be below the price unless you get a significant move. So you're still below the cloud there. But look at IWM. You're actually in a very strong, you're still below -5 and above 80. So you're still in a very strong bearish trend. You're still below the blue line. That's how bearish you are, still well below the cloud. And then look at the Qs, and you say, okay, still below the blue line. The red line's still easily below the price. We're still well below the cloud, and we're still in a mature bearish trend, below -5 and above 80. So nothing's really changed, per se, in the last little bit, other than volatility has really come down. We came down here to the peak last Wednesday. Here we are again, heading into inflation data coming up. At a very strong support level, whether it's on an absolute basis, 20 is a big round number for the VIX, very strong support, or 85% on a relative basis is a pretty strong support level for the VIX when you've been above it like we have been. When you look at it on this chart, the volatility index on this chart, you can see the VIX essentially has come down towards its 200-day moving average, well below these moving averages. So, very strong bearish divergence. But remember, we've been looking at this on a long-term chart because we've had a little bit of a change in volatility, and now we're above all these lines. 200-day, we're essentially sitting right now on the 200-day. The 30-day has crossed above, just barely, but the 30-day, after being below the 50 for all this time, is now above the 50. So, and we're pulled back down to it. So again, an opportunity for VIX to either break significantly and get down towards 15 again, and we'd be very bullish, or hold this support like you actually would expect it would and bounce back up. So it kind of shows you, how we're going. If you look at the VIX on an options expiration cycle, because we're getting close to the end of February, you can see, some of these other strong bearish volatility levels got down to much lower levels than what we're getting right now. We've had 3 consecutive expiration cycles of rising volatility, and we've had one so far that's basically retraced. And now the question is whether we'll continue to move up higher now that we are above the 200-week moving, or in this case, a 200-month, the 200-month moving average, which is that blue dotted line, the 200-month moving average, which would be a monthly chart on the options expiration cycles, not your typical monthly chart. So what do you think? So again, my take is this has been a nice little rally. It hasn't been a trend-changing rally, though. The impulse moves are still to the downside. It's been a good, strong pullback to the upside, but I'm still not buying the pullback because I'm not seeing the breakouts, right? I'm not seeing the strong breakout moves with the technical signs that accompany them. I'm just seeing, a bearish, a correction that we're in, whether it's barely starting the NASDAQ or full on into it in the Russell and haven't started in the S&P. I'm seeing a good little rally within a correction, but doesn't have the hallmarks of a rally that changes the trend and changes the impulse moves from being down to being up. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're a lot more bullish than I am? Or, yeah, it might actually be a lot more bearish than I am right now. What's pointing you in that direction? Share with us what you're seeing in the comment section down below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today. You want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. You don't even have to watch if you don't like it. Also, comments down there on the video. What stood out to you today? What questions or comments do you have about anything I brought up in the video? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these other things over here on the right and click on this link that takes you to our Market Outlook live page. This is where I review all the Market Outlook trades that we've done in these videos to see whether we should stay in them or get out of them, move on from them. We talk about managing them. We also put on today's trade idea. You'll hear at the end of the video, already on before the market close. We did that here. It's at 3:30 Eastern Time, Monday, Wednesday, and Fridays on this page. You can also get to it by clicking on Market Outlook Live Trade Review. If you see these, you can see our upcoming classes over here as well on the right. Click on View More. That takes you to our calendar. You can see our upcoming classes as well as nearly 4 years worth of recordings back there. You can also get to that by clicking on Trading Rooms right there. Come down to the bottom, click on that heart. Look, we almost got to 100. Click on that heart. It opens up this tab. Hit that like button. Also click on this thumbs up icon. Opens up this tab. Hit that like button. Again, the more you do that, the more engagements we get, the more people will see our content. That's why we always ask for it. It really helps us out. It also helps you out because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, let's take a look at what's driving the price action today. You can see pretty much a full risk on, aside of real estate doing really well. The Q is up 2%, IWM up 2%, S&P is up 1.5%. That's been a little bit different than normal, which you'll see here in a second. But S&P is up 1.5%. Emerging markets, developed markets outpacing the S&P 500. Commodities coming in lagging behind, or rallying up 1%, but lagging behind equities. Gold and bonds. Bonds are up pretty sharply earlier in the day before pulling back by the end. Again, that's kind of a reflection of yields. Yields moving down today. If you take a look here, let's take a look at this chart for TLT. And you can see, again, we had gone a little parabolic here on TLT to the downside, and definitely getting a divergence opportunity setting up with a higher low developing here with a much lower low on the chart, well below the 8, well below the 17 day moving averages there. So not surprising we get some bullish movement, and obviously we can get a lot more bullish movement and still be not as not as down to not as bearish. You can see IEF, which is more closely tied to TLT, also still pretty down there. And then of course SHY, which is tied to the Fed funds rate, and that SHY is actually down today. It's way down, and it will continue to be way down because it is the Fed is now expected to raise rates here. If you look at the rate hike schedule here, you can see the Fed's expected to raise rates here. Let's refresh the page. Now there's like about a 54% chance of by the end of the year of 6 hikes. You can see here. Let's see, 100% for 3, 98% for 4, and then you can see, 97.9 for 4, 84% chance for 5. So we've got 5 rate hikes baked in, and then 52. It was up to 54 earlier today. 52% chance. And if you look at what's interesting to me today, is you had a break of the 60 basis point level on, which has been holding here for a while on the yield curve. So when you look at this, right here, we're at 194.50. Subtract that from the 2-year, which you saw 194.50 minus the 136.60. We're at 58 basis points. So we have broken the 60 basis point mark on the yield spread. That's a significant break. Again, it kind of shows that even though the Fed's expected to keep raising rates 5 times, if not a 6th time in this year, there's not a whole lot. I mean, this kind of shows there's not a whole lot of room. That yield spread, there's not a whole lot of room to get there, and that will reflect here on this chart. This chart right now, as of what would be yesterday, we were at 60. There we go. We were at 61 basis points yesterday. This has been updated for today, and then there's your breakdown. So that's the first time we've been below 60 this entire time. You can see getting below 80 was significant, but getting below 100 was significant. Getting below 120 was significant. So you can see how these are significant levels to break. Now, granted, you can see you can break 80, and we didn't really break until we broke 80 the second time that it really didn't come down. So, but this is the first time that we've broken 60, and again, getting to 40 will just be that much closer to an inverted yield curve, and the Fed hasn't even started raising. The Fed hasn't even ended tapering yet. The Fed hasn't even started its quantitative tightening program, and it's already almost at an inverted yield curve. So it goes to show, that again, it's not actually a bad thing for the Fed, for the markets, for the Fed to be raising rates, and it's not a bad thing for the yield curve to be falling for the stock markets. But again, considering that we're still well below these moving averages here, these long-term moving averages, and if you take a look at the weekly version of this chart, again on the S&P, we're actually up above the 17-week and 8-week again. And if you look at the diamonds, we're actually easily above the 8 and 17 weeks. So it's almost like nothing even happened here yet. There's been no weakness per se. But that's the different story when you look at the Qs, which are still below the 8 and 17 week moving averages, and of course IWM, which is in full-on correction mode. It's still below the 8, and that's how low it was. It's still below the 8, but it is well below the 50, well below the 50. So we are in full-on correction mode. MACD is well below 0, even if it's not quite there on S&P yet. All right, let's take a look at how the different markets are doing here. You can see a lot of the developed markets look exactly the same as the U.S. The Japan looks very similar. EWG looks very similar. The only difference is their intermediate lines are rising, and they're still falling on the S&P, but just barely, right? Remember, it's just kind of sideways. All of them below 50. Italy is up above its moving average. France is above its moving average. UK is well above its moving average. India is kind of, looks very similar. Russia looks very similar. Brazil has got a strong move. Canada looks very similar to France, and then Korea. So they're all different stages. China as well. You can see kind of which ones kind of look similar to each other, and which ones look very similar to the U.S. So they're all very similar looking charts, all different degrees of coming off of these lows that we had from a couple of weeks ago. Again, the question being whether or not they're trend changing lows. When you look at the 12 grid of the different asset classes here, you got your safety trades up here at the top, sideways in the dollar. The bond we talked about being extremely oversold. Gold is rallying. You can see the big breakout move we had on copper today. Very, very big, but not followed up with a bigger move on silver. Right? From an industrial standpoint, when those two things are going together, that looks really good. So we'll see how significant and how much that holds. Since we didn't get the accompanying move there, you can see emerging markets looking very strong, up above 50 on their intermediate line. The dark green shading and a green line now. So we don't have that on the U.S. We don't have that on developed markets. So some relative outperformance on the emerging markets, and commodities still holding up very well. Bitcoin, we talked about Bitcoin here. It's still in this bearish mode. Below its 50-day moving average, and really small ranges. Like we had a big range there of, what would that be, 4,000 points. then a range there of 3,200 points, then a range of 2,800 points, and then today's range of 1,700 points. So gradually getting smaller and smaller as we're heading up towards Fibonacci resistance, that 38% line sitting right at the 200-day, right at the point of control for the 1-year chart. The 50 days kind of stopping us short of that level as of right now. So, and then you can see now the histogram rolling over. This is kind of the pattern you would expect to see on the S&P 500 if this is, and all these major indexes as we head into these their own respective resistance levels. Finally, let's take a look at the sector moves. So let's come over here to the sector moves, the 12 grid right there. And you can see, obviously, you can see the main drivers of recent bullish markets are right here, and they're all still kind of struggling to different degrees. Industrials, materials as well. Again, you know, from an industrial complex standpoint, you'd like to see those two kind of building up. Energy is doing very well on a relative basis. Financials, that's where your pockets of strength are. Your safe haven areas are in very bearish mode too. So, you know, kind of some, you know, interesting patterns. You know, light pink, light green shading, yellow line across some of these sectors. Dark pink shading and a red line still on a lot of them. And then, you know, you only got dark green shading and a green line on two. But again, those aren't necessarily the two market leaders you want to have because they're the smallest weightings, two of the smallest weightings in the S&P 500. All right, now let's take a look at our trade idea of today. And I wanted to take a look at ServiceNow. It's actually got a pretty interesting looking chart. Unlike the S&P, it's actually breaking through its moving average. And you can see it's the near-term line breaking well up to high levels, the highest levels that we've seen in a while. The momentum line is now in overbought territory too. We're 8% above the moving average. So that's a little bit different than what we had seen previously, where we're just kind of flirting with being above the moving average and just flirting with it there. Not flirting with it this here. That's a pretty significant breakout above the moving average there. When you look at some of these other charts, you can see that you got a couple good cream bullish, but in this one with the green arrow, rising PPO, it's different than the S&P, coming from negative levels. And then, of course, your positive differential down there at the bottom. Looking at some of these other oscillators for ServiceNow, a pretty decent breakout. You're not quite above 60, but you're knocking on the door. You're above 100 on the CCI. Good breakout above those highs there. When you look at the the DMI, that's what I want to look at. What's interesting about the DMI is you've been so bearish that you're about to get a bullish crossover at the lower levels. Like the negative indicator's been below 25 for a while, but the positive hasn't really gotten going. So, and with the ADX at high levels already, you'd expect there's going to be a pretty decent move on that positive indicator up to the upside. And so, let's see here. Let's take a look at the Bollinger Bands too for ServiceNow, and you can see that we are in the upper quartile of the bandwidth, you know, in the 81st percentile. So we're out of the middle. We had been in the middle. This was in the middle, and we broke out of the middle there. We broke out in the middle, and we're in the upper bandwidth again with already high bandwidth. And we're breaking above the value area, breaking above this volume node, which had been holding us back in the past week. We broke above that, broke above. So there's some pretty good positive signs that I think a lot of people are kind of hoping to see out of the broader market. But you are seeing here. So if I were to come to the options, we decided to do a bull put spread on this, selling the 580 put, buying the 570 put, looking for at least, for a $10 wide spread, looking for at least a $230 reward. That gets you roughly about 30% return on risk. And that's what we ended up getting. I think we ended up getting $290. Yeah, we got $290. And then you can see that break even's down here. So the break even would have to get back below the 50 and 200-day moving averages, back below that volume node that you broke out above, back below the 8-day moving average we've been above, and probably back below the 17-day by the time it's all said and done there. So it'd have to really require a pretty significant change in direction for us to get to our loss on that trade. So that's our trade idea for today. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Apply to anybody else's threads. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Click that thumbs up icon. Like us on Twitter and Facebook too. Comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.